I grew up during the last recession and my parents had a house foreclosed on. Maybe if I make enough money, save it well, invest it, I could go live on a beach or something in 10 years. Bought my first home in 2014. That first home snowballed into a little bit over 10 homes. Friends would come to me looking for advice. Ultimately, that became the genesis of DOORVEST. I never got to live on an island, so maybe I'll try that one day. I'm still in rainy San Francisco.
Welcome to Value Add, your edge in building wealth. Hey, Andrew, thanks for joining. We have Andrew from DOORVEST'S here today. How's it going?
Can't complain. Excited to be chatting.
Awesome. So DOORVEST, you guys have been around since, I believe, 2019. Maybe you can talk a little bit about your journey and then tell us a little bit about DOORVEST.
Yeah, for sure. The general background is that I grew up fortunately middle class, never financially secure, but we were okay. My parents made ends meet. We faced some financial hardship, especially with like macro things and things of that nature. I grew up during the last recession and my parents had a house foreclosed on. So obviously that brought a lot of volatility to our family. Fast forward some years, ended up in startup land, not by design. I was lucky to be in SF for school. And then secondly, I was also just like really bad at school. So startups was like the only people that would hire me. So anyways, started to have a job, really thrive during the day with my day job. The nights and weekends began to amass some savings and then started dabbling with avenues to generate some income security. Maybe if I make enough money, save it well, invest it, I could go live on a beach or something in 10 years. So that was kind of the dream at the time. That led to a number of different investments, but found some good success in real estate. So bought my first home in 2014 in Sacramento, California. The numbers were very different at the time. It was $96,000, 3-bedroom, 1-bath, cheapest home in the entire city. The guy that sold it to me bought it out of the bottom of the last recession for $40,000. I was like, oh my gosh, made a killing on it. But anyways, that's to say, that first home snowballed into a little bit over 10 homes. Then friends and whatnot would come to me looking for advice on how to get started. There was never really a platform to point them towards. So ultimately, that became the genesis of DOORVEST.
What did you find the benefits to owning a rental property?
There was a lot. I think the immediate one was back to sort of the vision of passive income so I could go live on a beach. So real estate and investment homes specifically, there's sort of this very predictable revenue stream, right? It's like you buy it for a certain amount, you have all these operating expenses, and then you have sort of predictable rents that come in every month and then they grow over time as well. So then you can kind of do basic math and you're like, okay, well, here's how much I need to live every month. Then one home equals X dollars of cash flow and you multiply it across several homes and you give it some time so the rents grow and then maybe you pay some of your mortgage and boom, you go live on a beach. That was kind of the initial concept. Then as I started peeling the onion back, I think that's where I learned the power of real estate, one of which is leverage. You're able to buy homes, you could get really attractive mortgage terms and rates. Even with the higher interest rate environment, there's still really cool and creative ways that you could leverage mortgages. It's kind of what led to the snowball effect where I could leverage existing homes, pull out some equity, buy more homes, etc., amongst some of the other tax benefits and things of that nature too.
Gotcha. So for you, it was a cash flow game, getting that passive income as opposed to like, oh, I buy this property, trying to value it accordingly, hoping for appreciation.
You know, that was where I started. As of today, it's shifted quite a bit. So where I started was like, oh, this seems like a great way to generate some cash flow. Over time, it evolved to how do I build a meaningful nest egg through it? So from there, the profile of the homes that I started focusing on shifted to being more homes that are really solid homes, great neighborhoods, have good long-term upside potential. I'm not saying, oh, next year it's going to double in value. That just doesn't happen. But like over the course of 10 or 15 years, will it double in value? Homes are relatively low maintenance, i.e. passive, because I want to be spending my time working on other things that I find more interesting. And I'd love for this to grow and create some value over time by itself. So yeah, to answer your question, initially it was cash flow and passive income. Over time, it sort of became more of a long-term wealth.
So when did this go from a side hustle / getting your nest egg and going living on an island somewhere to, okay, this is a business and I want to build something here?
Yeah. Well, I never got to live on an island, so maybe I'll try that one day. I'm still in rainy San Francisco right now. I'd say my story was quite organic. So the same way I stumbled into real estate, bought one home, and then that began to turn into two, and 5 and so on and so forth. The story of DOORVEST itself was also quite organic. So along the way, people like our peers, my friends, my coworkers, my friends of friends, family, etc. As I started to accumulate my portfolio, people would start to come to me and were like, hey, I have 40 or 50 grand saved up. I heard you do real estate. Can you show me how to get started? I'm like, great. Here's my 30-point checklist of how do you find a market and an agent and write offers, negotiate offers, title, mortgage, renovate the home, lease it out, manage it, accounting, bookkeeping, all of that 10 times over. Gave it to them, handed it off to them, and then crickets. I'd always be like, hey, I'm always around. I love talking about this stuff. Give me a text. It was always crickets. And we'd literally, this happened like clockwork. We'd bump into each other at a friend's house in 3 or 4 months. I'm like, how did you do? Literally every single time. People would look back and we would talk. And yeah, no action. Couldn't get started. Still interested. Can you do this for me? It was like 5 or so years, 60 plus conversations. At some point, my stubborn mind realized that maybe there was a gap here. Late 2019, early 2020, depending on who you hear from. It's kind of when we sort of got off the ground.
Got it. I think that's a great segue into telling us a little bit about what DOORVEST is all about, how the platform works, what anyone who's looking to buy an investment property can expect to find on the platform.
So in a nutshell, at a high level, we make it easy for anyone, anywhere to buy and own an investment home online. You could think of us as sort of building Amazon for real estate. So we start with a consumer, what they're looking for. How much did you have saved up for real estate or allocated towards real estate? What sort of returns or cap rates were you hoping for? What's your general risk profile? And then on the other side, we'll source and match homes based on customer criteria and then do everything end to end. So we'll start finding homes based on your criteria. We'll keep going until we find something that you like. Once you say go, then we'll buy the home, renovate it, lease it out, and then begin management. So the home is fully stabilized, it's ready to go. You'll then buy it from us. And as you close and take title, we'll manage it on the back end. So kind of end to end. Lastly, where we position ourselves is hopefully we get a customer into their first ever DOORVEST home or possibly their first ever home. 70% of our customers are first time homeowners and then partner with them after they buy their first one and sort of build out their portfolio.
So you essentially take care of the sourcing to narrowing it down to purchasing, to renovating, titles, etc., and managing it as well. So practically the entire life cycle of actually buying a home.
Yeah, exactly. Those in the world of startups, the common wisdom is find your wedge in the market and make it super narrow and then just focus on that. I think there's a lot of strength and truth in that statement, but we kind of went the opposite, which is how do we own the entirety of the experience to be able to really deliver on the experience that the customer wants, which is owning real estate and not taking on the personal risk because you're leaning on a company and a platform that knows better than I. So yeah, just kind of end to end of real estate investing.
So I'm assuming that's why you had to raise a ton of cash for DOORVEST, right? Because you're actually purchasing these properties and then selling them and actually doing the renovations as well. Very capital intensive, very non-typical tech. So if I'm not mistaken, you had your last funding round in mid-2022?
Yeah, that's right. We're one of those businesses that use debt as fuel. So similar to a credit card company, we raise a bunch of debt in order to fund the acquisitions and the renovations, effectively stabilizing the home for the end customer. We're constantly raising and servicing our debt. Then, of course, as a venture-backed startup, we're raising equity to fund day-to-day operations and paying salary and R&D and keeping the lights on. But yeah, have sort of this capital element to the business.
Got it. So diving a little bit into the market research aspect of it, you have to start somewhere. You mentioned 70% of your customers are first-time home buyers. That's super interesting, actually. But I'm assuming you're enabling people to buy long-distance properties as well. So I'm curious to know, what is your market analysis or research process, or essentially your due diligence process?
At a high level, yes, we enable folks to buy long distance homes, but not exclusively. So customers are in about 26 different states. Sometimes it's in the market that they're buying and other times it's long distance, whether it be from some international location or just a different state, a different city, etc. Ultimately, it boils down to sort of the thesis that we're going after, which is sort of passive, reliable income. Yep. So the question is, where can you get some income and make it relatively passive? With that sort of thesis, it backs us into certain markets. So we're primarily operational in Sunbelt and Midwest markets where you could get relatively affordable home compared to the rest of the US, along with homes in great neighborhood that are generally more reliable, etc. From there, oh man, lots of diligence across a number of different fronts. Everything from basic financial diligence, like how much is this home worth? How much are the rents? How much does it expect to grow both the home value and the rents over time, to sort of like home specific diligence, like is there a big hole in the roof, is this home built appropriately, etc., down to resident diligence, kind of the whole 9 yards.
Interesting. I would assume the population growth, job growth, so the macro, the micro, the neighborhood specific, home specific due diligence, that's kind of all going into what I would call like some kind of model to kind of figure out where would you get the best properties or the best value. So let's say I'm an investor, right? Or I'm looking to buy a home. What can I expect to see? I have $50K to spend. I come to DOORVEST, knock on your door, go to your website. What's the process? What can I expect?
Thanks, happy to have you on as a customer. We'll start with that. And then it's like, are you looking for a home that's optimized for yield and cash flow? Are you looking for a great home, awesome neighborhood? Maybe if shit hits the fan, you could go move and live in there, or maybe something in between. What are you thinking?
I'm thinking passive income.
Yeah. Okay. So homes that are more sort of passive income, i.e. have more cash flow, they generally are homes that are a little bit more affordable. The rent to price ratio is better. Maybe the quality of the neighborhood is sort of the trade-off. So that sounds good. Then we'll learn a couple more factors based on you, timing, no mortgage, all that good stuff. Then we'll send it over to our acquisitions team, and then they'll start underwriting homes based on that buy box of yours, then is overlaying with our buy box. So our buy box covers the stuff that you mentioned earlier: the market, the home, the neighborhood, population growth, job growth, etc. Then the individual, sort of the consumer buy box, is kind of what we're talking about here. We'll overlay those two, and then that'll start funneling homes over. Then we'll start matching you with homes. Then we'll ask for your feedback. You'll tell us no, in which case we'll wonder why. And that's fine. We'll keep going until we find you something. But maybe we'll send you the first home and you're like, well, this home is, I don't know, a little bit outside of my budget because I know I have 50K, but I prefer to use 45 and save the rest as reserves. We'll keep filtering until we get one that you say yes to. Once you say yes, we'll ask you to sign a contract for the home. Then we as DOORVEST will buy the home and then we'll renovate it with our own cash. That's the debt that we talked about earlier. Once the home is ready to go, bring it back to you, and then you'll purchase and take title from us.
Got it. So me as a customer, what kind of fees can I expect?
The way that we make money is designed to align our incentives with that of, again, a long-term focused passive investor. So we think the biggest milestone is being able to add to the portfolio. So on the transaction, we target about 5%. So call it 200K, we try to make about 10,000 or so. Then ongoing, we generate a 10% management fee. So that equates itself out to somewhere between $100 and maybe $300 a month in sort of management fees.
That's over how long, the management fee?
Hopefully you buy that first home from us, you have a great experience, you save up for more down payment or get a liquidity event, something of that sort, and stay with us for a long time, and then add more homes under management over time. Of course, at the end of the day, it's your home, so you could do as you see fitting. Hopefully, we earn your trust and your business to continue with us, but we just ask for your commitment.
Got it. So let's say we went through the transaction, I bought a place, this is amazing. What can I expect in terms of cash flow starting off, and then I guess in the future?
Yeah. So with 50K, you probably have to get a mortgage. So of course, the mortgage payment becomes your biggest sort of cash outlay on a month-to-month basis. The rents more than cover it, and therefore you're left with some cash flow. We're somewhere in the $100 to $250 range, depending on the home that you're looking for. Sounds like you're looking for something with a little bit more cash flow, and so we'll probably be closer to the 250 range. From there, the factors that do change is that rents should grow in the markets that we're operational in. We've seen historical rent growth. And so 3 to 5% on the top line of the rent every year. Your mortgage payments are fixed, and so that stays the same. Then at some point, your residents help you pay off your mortgage. You get a fully paid off home. The rents have grown a bit too. So then maybe you start at 200, 250 over the next 20 years or something. At some point gets paid off, and now you're netting like 1,500 or something. That's kind of the vision that we share with customers too, is like, you have this 1,500, then over time you stack on a couple more, and then that quickly becomes a good source of income.
So once we purchase, one of the key risks is actually finding a tenant, right? There's the whole tenant finding process, and then making sure that they pay. How does DOORVEST help with that? How does that process kind of go?
Yeah, this is sort of one of the many elements that we're looking to de-risk for the customer. So we as an institution, economies of scale, et cetera, data sources, proprietary data, paid data, et cetera. We have sort of this scale efficiency that an individual doesn't have. So it starts with us underwriting and forecasting the rents. From there, we have to make it happen because we actually put our dollars behind it too. We'll guarantee the rents. So we'll find the residents, we'll collect on the rents on a month-to-month basis. If there's any lapse, then we don't make fees and or we have a guarantee on it as well.
That sounds like a pretty good deal. I'm curious to know how you manage that on the back end.
Well, it's a lot of awesome team members, lots of processes, constantly evolving process. Like on one end, I look forward and I'm like, holy crap, there's so much that we still have to do. On the other end, I'm like, oh my gosh, this is great. We have so much left to do and therefore we could just get better from here. So anyways, the short of it is a lot of people, a lot of processes, and a lot of tech.
Got it. Do you help your customers understand the tax benefits, how to take advantage of that? I feel like one of the big selling points of real estate is not only the passive income, which is amazing, right? You have three kind of pillars in my mind, right? The passive income side, cash flow, then the appreciation, potential appreciation may or may not happen depending on the market. So a lot of appreciation in the last 2 years. And the third pillar is the tax side of things, right? So I'm curious to know your thoughts on that and what DOORVEST does for that.
Oh man, I love this. Actually, before I get into that, it sounds like you've studied quite a bit into real estate. I didn't get the chance to ask you earlier. Have you been sort of studying?
I have not. I am like one of your friends who would ask for advice, has done a lot of the research, done a lot of the diligence, and just hasn't made the actual move, right? I might be a customer.
That'll be great. I would love that. So it's kind of funny when you say one of my friends, because back in the day, well before DOORVEST, I wrote a post, which was like 4 reasons why I love real estate. So it's exactly what you said. There's like the cash flow, the appreciation, the tax benefits, and the fact that your residents help you pay down your mortgage over time too, equity buildup. Anyway, in terms of the tax advantages, I think we do light education. I think we could actually do a better job, and we're continuing to improve that over time. One of the things that sort of blows my mind amongst many other things is sort of buy a home. It grows in value over time, right? Of course, market dependent, home dependent, neighborhood dependent, et cetera. But generally speaking, real estate values go up. Then you make some money. You want to trade up from like that home with a lot of yield to like a great home. You take all of your capital gains, you roll it into the next property through a 1031. You pay no taxes on that. And then you keep going until you die, and then you pass it on to the next person and they pay no taxes either. That's kind of some of the power of the tax advantages amongst others that you get to capture along the way too.
I think on the tax side, is also a lot of people talk about appreciation, but not enough people appreciate depreciation.
Yes.
Depreciation is another gold mine that over time is really, really helpful. You can deduct and depreciate a lot of your assets, even fixtures and stuff in your homes. That's super cool.
Yeah, agreed. This is another big one too. So we talked about, call it 200 to 300 bucks in cash flow per month. We'll multiply that across 12 months. You're making like $2,000 or whatever a month. But your depreciation, which is not an actual loss of yours, it's like a paper loss, counts against that. It'll most likely make that $2,000 negative. And not only is it negative, you then take that negative amount and then you write it off against your ordinary income where you're paying like 30, 40% on taxes. Again, not tax advice, but this is sort of some of the nuggets that I think are really fascinating once you triple click into real estate and tax advantages.
Absolutely. One of the other very interesting things I learned about, I'm not sure if you've heard of it. If you have a self-directed or solo 401k, for example, you can actually invest your pre-tax dollars in your retirement, from your retirement savings into rental property that you're not actually living in, right? So like as long as it's income generating, the passive income goes directly back into your retirement account. But again, just like super interesting things that I feel like a lot of people just don't know about, haven't heard about, aren't familiar with.
Yeah, have heard of that and haven't done it personally, but have heard of it. We have a number of partners in the self-directed space. So people that have pre-tax dollars use that to fund real estate. Found strong value proposition with those folks too, because in order for it to qualify and whatnot, it has to be very passive and hand off. So we kind of make it easy for folks to kind of do all of it.
Awesome. DOORVEST sounds amazing. I'd like to touch a little bit on the macroeconomic environment. Since 2020, real estate kind of took off like a rocket ship, right? At the time, it didn't seem like it made a lot of sense, but retrospectively, as a lot of things do, it kind of made a lot of sense, right? People were moving out of cities and people wanted more space. A lot of real estate markets got really hot. In general, real estate did really well as an asset class last year outside of publicly traded real estate, but I have a different opinion on that. But curious to know what you've seen in the last 2 years at DOORVEST.
I'll give you a personal one and sort of a more macro one. I mean, to the point of like real estate sort of going up quite a bit. That first home that I bought, 3-bedroom, 1-bath, 1-car garage in Sacramento, California in 2014. Cheapest home in the entire city at the time for $96,000. Again, I remember thinking at the time, I was like, damn, this must be the top of the market. The dude that bought it in 2010 bought it from the bottom of the market and made more than double in a handful of years. Like this doesn't happen in real estate. Obviously, I was so wrong at that time too. And then I guess to your point of like the rapidly appreciating markets as of recent time, COVID did a lot of things to dislocate sort of the economy and the world at large, including disrupting sort of the real estate markets. And a lot of that was subsidized by federal funds, I'd say. Then there was some of the macro factors that are probably more lasting, as you mentioned, people moving out to suburbs. But that's to say, the opinion is still the same, where on one end, it's clearly not going to last and keep going on at the same clip indefinitely. However, I don't think it sort of totally crashes. I actually think it reverts to the mean. Actually, if you look at some of the charts and you take out COVID, like the period of COVID, you kind of see a pretty normal chart that goes more or less up into the right over the long run. In sort of the more granular, which is like, I guess, post-COVID, pre-now, where interest rates are going up. Now there's another dislocated market where lots of folks, like the vast majority of folks, refied at crazy low interest rates from COVID, have next to zero incentive to sell their home and lose their mortgage. So inventory was already low. Now it's even lower. And then the folks that want to buy, it's more challenging to get to sort of make the debt servicing for the mortgage because the interest rates have more than doubled in a short period of time. It's just led to really low volume. Broadly speaking, of course, in different pockets, we've seen corrections. The markets that we're operational in, honestly, we haven't seen much, if any, softening. Question is kind of where we go from there.
Yeah, that makes a lot of sense. I would assume, as you said, there's a very low inventory in market. People don't want to sell given the amazingly low interest rate that they have. Now realizing that it was a pretty long period of time that we had close to zero interest rates, but that was probably a thing in the past. So how is that affecting you guys right now in terms of like providing value to your clients? The number of homes in general on the market is just low.
Yeah. What would actually be helpful for us? So a number of the folks that support our company and the company that we found inspiration from is Invitation Homes. They're the largest owner of single family rentals. They own about 80,000 of similar homes to the homes that we operate. They sort of bought the majority of their portfolio out of the previous recession. Makes total sense, right? Like rents are quite sticky and home values are more elastic. Lower home prices, strong rents equals really strong cap rates across the board. That's just not a dynamic we've seen to date. And honestly, I don't think will happen anywhere close to that. I think we'd be lucky in some of our markets to have like a 5 to 10% correction. It's kind of my prediction. It's actually more challenging for us, as you kind of alluded to. Like our customers come to us looking for easy experience that doesn't change in up or down markets. They're coming to us to be able to buy a home, doesn't change in an up or down market, but they're also looking for a little bit of cash flow. So within range, some folks look, maybe like yourself, are looking for a little bit more cash flow. Others are looking for 50 to 100 bucks a month to really give them some cushion and buffer because they're optimizing for like a great home. So that's to say, for us to clear that hurdle, the scope of the homes that we can go after is tighter. So one, creatively launching products that help with cash flow. Recently, we launched a product called Boost. It's effectively homes where we can make a little bit more profit, but we take that profit, we set it aside, and we feed cash flow for a number of years until the rents sort of catch up. That's one of the many things that we could do given that we have a compound business. So to what we talked about earlier, we take on a lot that gives us the ability to shift pieces around. So creatively launching products is one, and sort of the more linear piece is, can we open up more markets? So like the number of homes in a given market is lower, but the more markets we get, the overall more ability to be able to move forward.
market is pretty challenging, and it sounds like you're coming up with a few creative solutions. Assuming 2020 versus today, right? If I was doing that passive income purchase in 2020, 2021, you can pick whichever. Would there be like a year of negative cash flows kind of expected? And how has that changed fast forwarding now to 2023?
Yeah, actually, as you lay it out like that, all very different years. 2023 was very different from 21, which is also really different from 20 as well. We don't often stop to think about that, but it was fundamentally the case. I'd say rents continued to come in if you are buying the right homes. When I say right homes, it's good neighborhoods, good neighborhood scores, like your rental forecasts are accurate. Rents continue to flow in. In fact, they grew a lot over that period of time. The home price appreciation, certainly if we're going back to 2020, way outpaced the rental growth rate. If I could go back to 2020, I would actually advise our customers, advise myself to buy really nice homes, like the homes that would have given you break even or slightly positive cash flow, because in 2 or 3 years, the slightly positive would have amounted to the 200 or 300 that we're talking about earlier, along with lots of appreciation. Because even in a slower market, the appreciation, you always get leverage on that, because usually you're putting 20% down, you're getting a mortgage for the remainder. Even a 2% appreciation rate, which is sort of the historical norm, if you're leveraging that with a mortgage to like 5x leverage, like you are with a 20% mortgage, then that's actually 10% on your initial investment, sort of year over year. And that's pretty healthy. So anyways, that's to say, I would have urged myself to just buy even nicer homes in better neighborhoods and take the sacrifice of the incremental dollars cash flow.
That makes a lot of sense. So we're still in an increasing interest rate environment. Is there a interest rate at which this model breaks in the short term? Because I mean, the high interest rate is not going to stick around for a long period of time, but a high interest rate can drive mortgages so high that the market gets drier than it is. People don't want to purchase anymore. Plus, interest rates are increasing because of inflation. But with inflationary prices in other aspects of life and high interest rates, is there a place where this kind of breaks?
I guess the question is breaking from what vantage point? There's breaking from like DOORVEST, the business, and they're sort of breaking for the customer as an investment, both sort of slightly different, but oftentimes pretty aligned. From a consumer standpoint, mortgage rates specifically, I'd say something that most people often don't quite grasp is that mortgage rates are forward looking. If the general mortgage lending market believes that the Fed will increase rates next cycle, the following one, et cetera, they'll factor that in today into the mortgage rates. So from my vantage point, I believe that the mortgage rates have already factored in where the Fed is going to raise rates to. That being said, the most challenging piece to us as a business and our consumers is mortgage rate uncertainty. So where it was really challenging was end of Q1, early Q2 last year, or early Q2, I would say. Yes. Like every other day, you'd open the news and it was like, mortgage rate shot up, mortgage rate shot up, mortgage rate shot up. That's where the entire sort of investing world freezes to wait out the uncertainty. I would say that's probably the most challenging for us and the consumer as a business is sort of the uncertainty. We have certainty now. We have certainty that we're going to be in a higher interest rate environment. So that's better. That's better. Obviously, lower rates are probably generally better for us because our hurdle is lower and therefore the scope of the homes that we can go after is much higher. But uncertainty is the worst one. For folks that buy a home prior to higher interest rates, it's actually generally favorable in the sense that the higher the interest rate is, like housing is a fundamental utility. No matter what happens in the world, people will need a place to live, especially affordable housing, which is kind of the segment of the housing stock that we're focused on. Yep. So if you buy a home with a purpose of renting, increased interest rates actually means that there's probably higher demand for rentals because folks can't or do not want to buy a house given the mortgage rates. So there's a lot of different factors, I'd say, but if there's one takeaway, uncertainty is bad for business.
It's hard to have like an outlook, especially when things are changing so quickly. Great example, just last week, SPV went belly up. Maybe let's touch on that a little bit, right? Crazy times. It was less than 30 hours that the FDIC had to come in and take over. Were you banking with them? What kind of pains have you felt?
Yeah, we had banking relationships with them. It wasn't all of our capital. So we would have been okay for the short term. Of course, depending on the time horizon that it would have taken for everything to get resolved, we probably would have had to move things around or find additional capital, at least temporarily, et cetera. But generally speaking, I think we were in a better position than some others. We certainly had exposure, but better than some folks that had 100% exposure. So, I mean, obviously at this point, that saga is over. And I think the resolve was exactly what we could have hoped for. This is kind of where government oversight, there's a lot of value, especially with the US being the global reserve currency. So that's kind of that piece around uncertainty and whatnot. No one could have really forecasted that. Like summer of last year or March this time last year, no one would have been able to forecast it. There's some of this uncertainty that gets layered into the market from time to time and kind of throws a wrench into everything.
I definitely agree. That saga is behind us, but I feel like there are going to be a few ripple effects. I'm curious to know what your thoughts are from, for example, the last time a bank run happened was, I think, Wachovia in 2008. That was a function of mortgage-backed securities and the likes and the financial crisis. In some sense, Bear Stearns kind of catapulted us into a recession back then, right? What ended up happening was, rightfully so, credit markets got tightened. So banks were not lending as much because they had laxed their lending standards too. So the market was, from a credit perspective, very dry. But at the same time, the Fed, we had high interest rates at the time. And so the Fed could lean on reducing interest rates, right? A lot of people are banking on the Fed kind of reducing interest rates by the end of the year. I'm not so sure whether that's going to happen or not. But I'm curious to know what your thought is about the kind of drying up of lending to companies, to whatever it might be. Venture-backed companies are obviously more risky, right? That's built in the thesis. But what's your outlook on how that might affect us or as the VC startup community in the near term, long term? That's a loaded question, but I'm curious to know opinions and just chat about it.
I'd say at a high level, what we've seen is that this is sort of a white collar recession, as some folks have said. I would take it a step further, and it's like very much a high growth tech recession. Like we see it in the jobs reports and we see it with the rest of the world, like the layoffs, the sort of like company market caps that are getting eviscerated. This is very much concentrated in high growth tech, and it's a direct function of increased interest rates. There's sort of discounted cash flow models that have inputs for the implied interest rates and things of that nature. So I do think that SVB itself, I mean, they have that name for a reason, and they're a major player in sort of the ecosystem. They had a lot of exposure. I mean, roughly 50% of venture-backed startups banked with SVB. Those companies where SVB saw the run-up as there was the high-growth tech boom, they also saw the downturn as these companies started bringing in less money, et cetera, and their balance sheet got weaker, et cetera. In hindsight, it makes sense, right? It's just sort of bound to happen because companies were getting less funding, SVB would get less deposits, and then you compound that with the fact that the way that they were investing and oftentimes giving these same company loans, there's sort of like this major crash effect. Then you drop in the bank run and then it was clearly game over. If you take out the bank run, they actually had an okay balance sheet. They weren't at jeopardy of going out overnight, but obviously the bank run kind of led to that. What does this mean for the ecosystem at large? Well, fortunately, faith in the US financial system is restored, I'd say, at least in the short term. Of course, if we have bank runs at all of these regional banks, the Fed is going to stop stepping in at some point, or maybe not, but hopefully this is a very improbable case. I'd say largely speaking, it's kind of more of the same, just like the tech and the high growth tech space is just going to continue to get clobbered. Fortunately, it could have been much worse. Wasn't. The question is, when do we get out of this? It's a function of inflation and kind of what's happening in the rest of the world.
There are plenty of analysts trying to figure that out. Do I think the Fed will let multiple banks fail? No. It will lose faith in the U.S. economy and the U.S. banking system, which is kind of fundamental to how a capitalist society like the United States actually works. Part of capitalism is also taking risks. So we've seen multiple cycles. If you look at history of finance or history of banking, or bank runs happen, crises happen, recessions happen, and we learn and then we carry on, and then we're humans, and then we make the same mistakes over and over again. So that's kind of the boom and bust we've seen for hundreds of years. I think this was a great conversation. One last question I have for you. You've been buying houses or rental properties for a long period of time. Curious to know, what was like the one biggest lesson you've learned, or if you could go back in time and tell your 18-year-olds a lesson that you would have liked to know back then, what would that be?
Semi-relevant to our conversation. I kind of told you the story of like the first home, 3-bedroom, 1 bath, 1 car garage, cheapest home in Sacramento, pretty tough neighborhood, etc. At the time, I was very much optimizing to extract the most possible cash flow. That's how I ended up there. To give you a sense of how this home was, at one point, I had a resident that vacated. Home was empty. I was coming to check up on the home. I walk in and there's this homeless lady cooking on the stove. And she looks at me and she screams at me. And she's like, "What are you doing here?" In my mind, I'm like, wait, this is my house. And I obviously was freaked out. So that gives you a sense of kind of the neighborhood that I was operating in. I think the biggest lesson that I learned over time was I do think that the majority of the cash and wealth that you build through real estate is through equity buildup and home value appreciation over time. I'm not saying like in the next 3 months or in the next year, et cetera, but really over time. So the question was, how do I optimize for that? It's usually slightly more expensive homes, certainly homes in better neighborhoods. What I would have told myself is to go a couple tiers up from where I was at that time. The long story short is I don't own that home anymore because it was way too much of a headache. And there was actually property management companies that would tell me, we cannot manage this home in this neighborhood. So that kind of left so much money off the table because when I sold, I was fortunate I did fine, but I could have done better had I been able to hold on to it longer.
I feel like people find it hard to kind of think long term, especially as our attention spans kind of get smaller and smaller. If I had to summarize that lesson, or my takeaway from that would be get in for the cash flow, stay for the long term appreciation. To that extent, kind of better properties, good neighborhoods, pay the extra dollar, and kind of go from there.
Yeah. The last piece on that is, and I think I heard this somewhere. I don't remember exactly where, so I can't give credit to someone, but it was like earned versus learned wisdom. You could learn that wisdom. Like I could say this all day to a younger version of myself and others, but people aren't going to listen. I mean, hopefully some people listen, fine, thanks. But like the reality is I had to earn it myself and feel the pain of it and look back at the home value of that exact home today and think to myself, damn, I wish I could have held on to it to really learn that lesson. So I think it makes sense. And it's kind of to our theme from earlier, just human nature.
I love that thought. I feel like it applies pretty much everywhere, right? In 2020, everyone was an investor. In 2022, everyone was a loser. But unless you felt the pain and loss, I don't think you're actually an investor, right? Because markets just go up and you don't actually understand the risks of that, which 2022 was front and center. Great example. You don't actually learn about investing, right? You think that things just go up. Thanks for sharing that quote. Andrew, it's been a pleasure. Thanks a lot for joining us. Hope to have you on the show again.
Yeah, thanks, man. This is so much fun.
And that's today's value add. If you liked today's episode, hit that like and subscribe button. For long-form written content, subscribe to my newsletter. Otherwise, say hello on Twitter. See you there.